So how important is your credit score to your ability to buy a car? Well, we've got some statistics that say it's pretty darn important if you want to keep your payment as economical as it can be. Also, we're going to talk a little bit about the IRS finally got its homework done after 4 years of scratching their head as it relates to the final rules regarding inherited retirement accounts. And then we're also going to talk a little bit about one of the investment options that you have, assuming you have a high deductible health insurance plan, that really is much more powerful than the current thinking is on that. So we will have all of that on this week's episode of Dollars and Cents. My name is Joel Garris, certified financial planner, certified financial fiduciary. Joining me this week on the program, Christina Lamb. How are you this morning?
I'm doing well. How are you?
Excellent, excellent. Christina is also a certified financial fiduciary as well, as is everybody on the team at Nelson Financial Planning. She also happens to be an IRS enrolled agent as well. So good stuff indeed. So this car buying thing, if I recall, Christina, you just sort of embarked on this little journey, if you will.
I have been on the car purchasing journey. It's been a while for us. We keep our cars for quite a while. So I spent a lot of time looking, went several weekends, and kind of due to my personality, I felt like I needed to look at all my options and just make sure I was picking out the best car for my situation.
But that's good. That's what you're supposed to do. And more importantly, love the fact that you, like many of the folks at the office, hold their cars for a long period of time. I'm still driving a 2015. That's just smart from a financial perspective. If you're constantly getting a new car every 2 or 3 years, that may not be the best financial choice.
No, absolutely. And that was sort of, I guess you could say, my heartbreak to a little extent, is the cars that I wanted didn't generally last that long. So that was, part of my decision making, and actually going back to the first place I started at, which is where I ended up purchasing a car. But overall, my experience was really great, and I think that's changed a lot in the car buying industry, I guess you could say. People were very pleasant overall. We did not find them to be pushy. So the experience went pretty good for us.
Certainly from a business model perspective, it's really kind of almost less about the selling of the car. Clearly, most of the profit is in the repair and the repair shop and the ongoing maintenance.
They were definitely pointing all of that out during financing, really trying to push that. And that was very true. I feel like as we were talking to the salesmen, they were just trying to make the experience good versus the pushiness. So, So one of the things that, we did find interesting was I got a great interest rate.
Okay, well, that must mean that you've got a good credit score.
I do. I have an amazing credit score.
Practicing what we preach here at Nelson Financial Planning. I gotta love that. That's good.
I owe that to my father, though. That's one of the things he always said. Just make sure you keep your credit score good.
All right. Very good. Very good. Excellent. Well, that is good stuff. But unfortunately, if your credit score is not in great shape, you've got some tough statistics about how much that can increase the cost of what you're going to pay for that car loan.
Yeah, absolutely. It's not pretty. So if you have a what they call a super prime rate, you could get like an 11.9% on average rate. And this is, on a wide range of credit scores, so kind of keep that in mind. If you're around near prime, the average was 11.9.
Across the board.
The board. So if you averaged out all the scores. Yeah. So if you have a super prime rate, you got 7.7, which is outstanding credit. Right,
that would be like 780 and above. So good credit. But so if my average is as you said, roughly around 12, okay, so 8 is quite a bit better if my credit score, and then the problem increases as your credit score goes down, I suspect.
Correct. So near middle of the road, near prime is 14.4. And then subprime is for people 500 to 600 on their credit score was 18.9, almost 20%
That's
on
almost
a
like
car loan.
Credit card
Yeah.
rate, if you will. That is just really crazy in terms of how much that credit score almost shifts. I mean, if you look at those numbers that you were sharing there, Christina, I mean, that's a shift of 10 percentage points between if you've got good credit, 780 above, if you've got bad credit, below 600. So pretty dramatic stuff in terms of.
I mean, I think the same thing that's sort of happening with housing, it'll determine what type of car you can get. I mean, 10 percentage points may mean, you're driving, not as high of a car that you may want or not as expensive of a car as you may want.
Right, and that's certainly a fair point. If you're in an environment where interest rates are higher, your credit score is going to make much more of a difference to you, which is why, it's so important. And we probably don't talk enough about it on the show, but certainly in our book, we devoted an entire chapter to credit score and how to improve it. Well, first of all, what makes it up, how to improve it, all of those kinds of things in our book, chapter 6. And shameless plug for the YouTube audience, I'm holding it up to the video camera, of Next Gen Dollars and Cents, chapter 6. Check it out because it really does talk a lot about what makes up your credit score. 5 different components make up that credit score, and what you can do to improve it. As you know, you can certainly get the book on Amazon. I think they were running a little bit of a sale. It wasn't usually at the normal $14.99 price the other day.
From time to time.
Time to time, yeah. So make sure you can check it out there. Order it. You'll have it, with Prime. You'll have it if you have a Prime member. You'll have it tomorrow. Yeah, that's how it works.
Maybe 2 days.
Or if you want to avoid having to pay for the book, as you know, if you're a regular listener to the program, you know that there's a secret way to get that book for free, and that is simply by scheduling an absolutely free, no obligation consultation with our office at Nelson Financial Planning. When you come on in, that's like the first thing they do. They give you a free copy of the book. I suppose you could turn around and run out, but
haven't had anyone do that yet.
Generally, people don't do that. That is for sure. And speaking of books, right? I guess it is school is around the corner, right?
Yeah,
When does Ethan go back?
Ethan goes back in just a few weeks, August 12th.
Wow, that's quick.
And he's a freshman this year, so big go back.
Big happenings in your house. Wow,
Yeah.
Wow. Going into high school. That is fantastic indeed. Of course, the timing of this time of year is when we do our annual school supply drive as well, so we're still doing that at the office. Happy to accept donations of new school supplies and even old electronics for recycling between now and September 1st. It benefits a gift for teaching and also tools for Seminole schools. So make sure if you've got some school supplies that you'd like to make sure that get into the hands of some worthy kids, just feel free to swing that by the office, drop it by. We'll make sure we're going to evenly divide it between a gift for teaching, of course, and tools for Seminole schools. So speaking of homework, as we think about the rest of this week's show, Christina, the IRS, I guess, it finally got its homework done on these inherited accounts, didn't they?
Yes. So there has been misunderstanding for several years, basically since 2020, about the guidelines on these inherited IRAs. And they've changed the rules in 2020, and it went from a life expectancy, which means you could stretch out your distributions across your life, to a 10-year period. But in between that 10-year period, did you have to take a distribution or not?
Right. What was the schedule that you sort of had to follow? It took them 4 years to finally come up with the final regulations on that. So we'll talk about that on the program. And then we will also talk about those medical IRAs, those health savings accounts, and maybe give you a different way of viewing that if that is an option for you. Now, remember, you got to have a high deductible health insurance plan in order to have a health savings account or a medical IRA, but there's really some power of compounding that could potentially apply on those types of accounts. So we'll get to all of that coming up next here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So certainly lots of conversations about Roths, and people have heard those conversations. There's over $1 trillion in Roths today, and we understand, of course, the benefits of that, right? You put after-tax money in, it grows tax-deferred, you take it out tax-free. But there's another account that only has like $40 billion in it, so hardly anything in that in comparison to $1 trillion versus $40 billion, and that is health savings accounts, medical IRAs, and those are triple tax-free, meaning that as opposed to the Roth where it's got to be after-tax money, no tax savings when you make that contribution. When you make that contribution to a health savings account or a medical IRA, you get the tax deduction based on the amount that you've contributed, and then it grows tax-deferred, and then when you're using it for medical expenses, it is tax-free. And unfortunately, the statistics, Christina, I mean, they're pretty low when we think about, what the percentage is that has health savings accounts.
Yeah. So only 7% of owners have balances over $10,000.
Yeah, so pretty low balances.
Pretty low balances. And then of the people contributing, less than 5% even max out their contributions.
Wow. So on this segment of the program, we're going to talk about these medical IRAs, these health savings accounts, what they are, how they work, what the benefits are, and more importantly, how you can kind of really maximize out the value of these pretty unique account options. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of radio stations throughout the Central Florida region. Also a top 25 financial planning podcast as well, so make sure you check us out on your favorite podcast platform. Any trouble finding our channel on your favorite podcast platform or on YouTube, go to our website, nelsonfinancialplanning.com. There you'll see the icons. Click on them. You'll get directed to the channel on those particular platforms. Of course, once there, so you don't have to do that again, just make sure you hit the subscribe and you'll get instantly notified of when we upload new programs, as we do each and every week. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary. With me this week is Christina Lamb, another one of our certified financial fiduciaries at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries, and they stand ready to help you improve your life with a successful and cost-effective financial plan. So, Christina, I mean, I think we've talked about this certainly in passing over the years. Medical costs just so high, and no sign of them slowing down in terms of the increase in how much people have to spend on medical during the course of a year.
No, absolutely. I mean, that's one of the biggest issues with folks retiring before 65 is health insurance.
Right.
The cost of it, just the cost, not even paying for the out-of-pocket cost, just the insurance.
Because the out-of-pocket, I mean, that really does add up pretty dramatically. I mean, most people, if you're with an employer, you've got at least some health insurance coverage of some kind, but perhaps you don't have dental, perhaps you don't have vision. I mean, there's a lot of medical expenses related to things that aren't necessarily, directly related to whether you have high blood pressure or not.
Yeah,
kind of thing.
Yeah, that's really true. I mean, I think we were reading a statistic about the average person spends about $1,400 on out-of-pocket medical, not even counting insurance, and that's per person.
Yeah, that's incredible. So a family of four, you're talking, very quickly, it's over $5,000.
Yeah.
Incredible stuff. So that's really where the conversation then turns to what the options are in terms of health savings accounts and medical IRAs. So Christina, what are health savings accounts? Kind of how they work? What's the story behind them?
Yeah. So basically, a health savings account is, as you said earlier, a medical IRA. So withdrawals are restricted to medical expenses. And you can use it sort of like a flex account where there's like a debit card and you just run your transactions through there. If you take money out, there's a 20% penalty if it's not for medical.
Right.
Now, that is waived once you're over 65, which we'll get into a little bit on the benefits of that option there. But basically how they work, they're tax deductible. So when you make your contribution, you get a deduction for that. They grow tax-free, which is one of the best benefits, and then you can take your funds out as long as they're for medical or you're over 65, also tax-free.
Right. So the issue there is, if you take it out and it's not medical, then obviously beyond the 20% penalty, you also would have to pay income tax on the profit. So in a lot of ways, it kind of works like a regular retirement account where you've got the consequence of okay, well, wait a minute, that income's not going to be tax-free, and so you've got to pay income taxes on that, and then there is a penalty. These accounts, clearly medical expenses. If you're over 65, you can use it for broader than medical because that 20% penalty doesn't apply. So an interesting kind of thought there on kind of how you might be able to think about those in retirement. They do have a pretty good contribution limit. What are those limits for this year, Christina?
Yeah, so again, similar to an IRA, the contribution limit for a single person investing into an HSA would be $4,150, and then for a family would be $8,300.
Yeah, so I mean those are pretty good. Those are pretty good amounts that you can contribute. The other thing, and I think this is a lot of the confusion out there about these types of accounts, is people think of them like they are flex accounts, and the big distinction is that a flex account is a use it or lose it. If you're putting money into a flex account with your employer, those accounts are designed where you've got to use all of the money by the end of the year, otherwise you lose the money. But a health savings account is very different.
Correct. You can keep the money in there. You don't have to use it every year. And in turn, it just keeps growing.
Yeah, so that's it's a really kind of a neat option. My oldest son, Nelson, has one. Unfortunately, he had some medical bills, so he wound up actually having to use it like a reimbursement account. So I'm going to talk to him about let's look at maybe some other options, because they really are pretty powerful. And I think you had an experience trying to get Ethan one as well.
Yeah, so my son has a high deductible plan, which in theory should allow him to have an HSA. And when I questioned it at first, they told me yes. And then as we started making contributions, they're like, oh, he's under 18. So one caveat is it can only be for folks over 18.
Correct. Got to be an adult.
Got to be an adult.
And you just hit the other sort of caveat, which is that it has to be paired with a high deductible health insurance plan. It has to be a qualified high deductible health insurance plan.
That is correct.
Can't be just I've got health insurance and I want to fund this. No, they must be paired together. So there are that kind of restrictions, but there's no income limits. There's none of that other stuff that you might typically see on a retirement account. And I guess the concept is, as we think about these, and those start to get a little bit more pervasive in the landscape of investment choices out there, because you can, when you put the money in, you can sort of pick if it goes into just kind of like a deposit account or an investment account. So you do have some options to kind of think about when you're putting money in.
Yeah, that's definitely something. If you do have an HSA, you should question your provider and see if there are different options available to you, especially if you're not using those funds. And we're going to tell you why that's so important.
Yeah, I mean, Christina, that's a great segue. I mean, I think the key takeaway here is if you think about this as a retirement type of account, right, and you just sort of leave it alone, much like you would if you were contributing to a Roth, and you think about that $4,150. That is the contribution that you can make. If you do that every year between age 30 and 65, and assuming sort of an 8% return, which is in line with historical averages, you'd actually have almost $500,000 in retirement.
Yeah.
So it really does. Remember, the power of that time and compounding works well for a Roth, but it also works well when you have a health savings account. So the kind of the key concept would be to not really think about it as a reimbursement account.
Yeah, set it and forget it.
Really, it's got a lot more power than people realize. So if you're a fan of the Roth, and obviously there's $1 trillion that says it's a lot of people fan of Roths, then the medical IRA is really even a more powerful option because when you're putting the money into the medical IRA, you wind up getting a tax deduction when you do that. So some interesting stuff, and certainly some things that we'll continue discussing in future episodes of the program. But we're going to take a break for now here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So certainly as the years have gone by of late, we've certainly seen a marked increase in the amount of retirement accounts that folks inherit. And I guess that's sort of a reflection of the landscape over the past 40, 50 years in America, where as pensions sort of died and people weren't collecting pensions when they retired, the funding of their retirement was solely based upon what they were contributing to things like 401ks and the like. And so now we see that generation aging and passing away. And so more and more people are inheriting retirement accounts, and when you do, the rules are very different, and obviously have changed pretty dramatically. Christina, I guess that's all just kind of part of the great wealth transfer that we've talked about on the program before.
Yeah, absolutely, and we actually have a chapter in our book about that, is what happens when you inherit funds. So this is one of the prime examples of that. Inherited IRAs have been around for quite some time, but they made some rule changes in 2020 that changed the special treatments and the redemptions that have to come out of these accounts.
Yeah, and that really is. I mean, there's a bright line in the sand, so to speak, on if you inherited an account from a retirement account from someone who passed away prior to January 1, 2020, or after January 1, 2020. That line in the sand, January 1, 2020, is really important and fundamentally changes really what your thought process should be as it relates to that particular account. So that's what we're going to get into on this segment of Dollars and Cents. So welcome on into the program where we help you make sense out of all of life's decisions involving your dollars, including what happens when you inherit a retirement account. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. With me this week is Christina Lamb, one of our certified financial fiduciaries at Nelson Financial Planning, also happens to be an IRS enrolled agent. Our entire team stands ready this week to help you improve your life with a successful and cost-effective financial plan. So this is really a major shift that depends on whether the person passed away prior to January 1 of 2020 or after January 1 of 2020, isn't it, Christina?
Right. So for many years, the guidelines were unclear about, do you need to take redemptions or don't you? So starting in 2020, if the person passed away in 2020 or later, you now have to redeem the account within a 10-year period of their passing. Now, prior to that, it was under what was called the life expectancy. So you could draw out the redemptions through your life expectancy.
Yeah, so the power of that, I mean, you think about, and I remember back in those days, we were often encouraging folks, maybe you don't name your kids as the beneficiaries on your retirement accounts. Maybe you name your kids your beneficiaries on your non-retirement accounts, and instead maybe name the grandkids. And if you're doing that, and someone that's 10 years of age with a 70, 80-year life expectancy, my goodness, the amount of time and compounding that could go into that, just very, very powerful. Obviously, the door slams shut on that as of January 1, 2020.
Yeah, so the two main things to keep in mind with the changes on the beneficiary IRAs is that the account must be fully liquidated at the end of the 10th year for the person that passed away. And keep in mind, those assets are fully taxable to you.
Yeah. Yeah, especially if it's a retirement account. Now, these rules still apply to Roths as well.
Correct.
But particularly if it's an account that's never been taxed, you're going to be responsible for all of that income. Frankly, I describe this as the single largest increase in taxation on your retirement accounts. that really doesn't get a lot of conversation in terms of, at the end of the day, that's what the implications are. Because if you're required to take a chunk of money out over 10 years versus previously you might have had 30, 40, 50 years, what do you think is going to happen to the tax bill?
Yeah, of course. It's going to go up.
It's going to be much higher.
Or people are going to spend it.
You're going to have to, well, that might be worse.
Issue.
Yes. But significant changes that really relate back to this, kind of notion of increasing taxes and the amount of taxes that people pay.
Yeah. And so the second rule that comes into play, and this is where it got a little shady with most people, and the guidance from the IRS was that every year you have to take what's called a required minimum distribution out of the account if the decedent was already taking that. So the guidelines in the past weren't sure, did you have to take a little bit out in between the 10 years, or could you just wait until the 10th year and let it all grow? But the final guidance is you do have to take a required minimum distribution if the decedent was taking one already, so that you'll have to take a little bit out every year.
So that's the key thing to be looking at. If you inherit a retirement account, was the person who passed, were they taking required minimum distributions, or did they have to take required minimum distributions, or did they not have to? And if they did, then you have to also take required minimum distributions. But that calculation winds up being based more on, back to where some of the confusion is, it's based on your life expectancy in terms of that required distribution.
That is correct. Yep, absolutely.
So you got like two different tables going on here. The decedent probably had to take out a required minimum distribution. If they had to take a required minimum distribution, they were doing that based upon their life expectancy. Mm-hmm. You, as the inheritor of the account, wind up taking it out based on your life expectancy, but you got to do it.
Yes. So basically, the IRS did this in efforts to raise more tax revenue, as you previously pointed out, and also, keeping the wealthy from shielding their assets, as you were describing, basically naming grandchildren as beneficiaries on accounts. So over all of these IRA accounts.
So at the end of the day, so just to really have folks understand what the issue is here, unfortunately, the IRS took 4 years, effectively, to come up with the rule of what you needed to do. And so a lot of people were on the impression of, okay, maybe we don't need to do anything. And finally, they issued out the final rules on this, but they effectively sort of exempt, right? Whatever happened over the past 4 years, forget about it.
Yeah, so they are not penalizing anybody that has not taken a distribution from 21 to 24, where they would have had to take funds out of the accounts. However, going forward, starting with 25, you must take that distribution out, and if you don't, there is a 25% penalty.
Plus the taxes that you would owe on it as well.
Exactly.
Yeah, so
and 25% is pretty steep, and it was 50 prior to 2023.
Certainly pretty steep. And again, these rules apply to Roths as well. We're focusing more on the pre-tax side, because there you've got the tax liability, and it really does require you to kind of really think this through a little bit more than maybe what you might have in the past, because the need to be thinking about who's going to wind up paying the taxes on these accounts, that could certainly generate a much higher tax bill if you're not thinking through on that perspective.
No, absolutely. So as a retiree, you may want to consider taking more money out of your IRA account now versus letting it grow for a beneficiary. And then from a beneficiary standpoint, you want to come up with a distribution strategy. That's going to be a little bit different for everyone, considering on your tax circumstances and your income circumstances. If you inherit something like a $100,000 IRA, grows at 8% for the 10 years, you don't touch it, it's going to be $22,000 at the 10th year, when you now have to take it all, and you're going to be paying much higher taxes on that.
Yeah, double. 100,000 turns into over $200,000, $222,000. So that becomes but now the problem is the people that have missed the 4 years.
Right.
So,
they now still have to redeem it in their 10-year period, so they only have 6 years left.
yeah, we're going to stay on that one a little bit longer, because that if you've inherited one of these accounts and you think, you know what, I haven't had to take anything out, you might very well have to take something out starting next year, again, depending upon whether the person that you inherited from had to take out required minimum distribution. So we're going to stay on this topic a little bit longer when we get back from the break. So stay tuned here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So, Christina, what a range on today's program, right? We started talking about cars, inheriting retirement accounts, health savings accounts, medical IRAs, and I guess that's why our book, Next Gen Dollars and Cents, remains such the hit that it is. At one point, it had hit the top 100 for its category on Amazon, because we have chapters that sort of talk about all of these different things, much like we've been talking about on the program this week.
Absolutely. There's a chapter for everything we've touched base on, even the cars, in the book.
Yeah, no, absolutely. And if you missed that part of the conversation, know that your credit score really, really matters in today's world when you're thinking about car buying, because that really determines the interest rate that you're going to get. As we were saying earlier in the program, almost a full 10 percentage points difference between if you've got a good score versus a bad score in terms of what that interest rate's going to be.
Yeah, I mean, I didn't realize it made that much of an impact.
Yeah.
And that's huge.
Huge. It almost puts that, if your credit score is not good, it almost puts that car loan up into credit card-esque interest rates, if you will. Yeah. So pretty dramatic stuff. Obviously, the book remains available on Amazon. However, you can get your free copy by scheduling an absolutely free, no obligation conversation at the office at Nelson Financial Planning. So check out our website, nelsonfinancialplanning.com. You'll learn much more about all of that, along with you'll find the way that you can fill out the little box on the website and reach out to us to schedule that absolutely free conversation. So before the break, we were kind of getting to the punchline, if you will, on what to do under this new regime involving retirement accounts and inheriting retirement accounts. So, Christina, why don't you kind of recap sort of what the big change is and how all that plays out?
Sure. So starting in 2020, if you inherit an IRA from somebody who passed away 2020 or later, the rules for distributing that account have changed, and it is now a 10-year period, which is a much shorter window than the previous life expectancy, which ranged the whole beneficiary's life.
That's exactly right. And then, unfortunately, it took 4 years for the IRS to finally issue out the final rules on those. So, Christina, in summary, what are those sort of final rules that people need to observe on these things?
Sure. So you must redeem the account within 10 years, or if the decedent was already taking an RMD, a required minimum distribution, you will also have to take a required minimum distribution through those 10 years until you fully liquidate the account. So if you liquidate it before the 10 years, you're okay, but if you keep it the full 10 years, every year you must take some money out.
And that rule effectively goes into effect next year, 2025. So the IRS has given a free pass for the past 4 years, so no harm, no foul if you didn't take any money out. But now, going forward, 2025, going forward, you've got to observe these rules. If not, it'll cost you money.
Yeah, so there's a 25% penalty that will be assessed if you don't take out the required minimum distribution, and you were supposed to, plus the initial taxation, which is your ordinary income rate.
Yeah, sure glad the IRS finally, got its homework done after a 4-year period of time. Imagine, so Ethan is going into high school.
Yep.
So he's got a homework assignment, and he gets it assigned to him in his freshman year.
Yeah.
And then he hands it in his senior year. You think that...
Is that okay?
Is that okay? You think that's going to work?
I don't know. The way they kind of did things was a little different than when I went to school, but
well, the IRS's eyes, the IRS's eyes, it's perfectly fine. It took them 4 years. I mean, and unfortunately, you, the taxpayer, have to bear the burden if you have not been taking out these required minimum distributions. Guess what? Your required minimum distribution is going to be higher because the calculation of that is based on the value of the account.
Right. And it's going to grow generally every year as long as, the markets are doing well.
So certainly some things to consider on that. I think the key concept, and Christina, before the break in the last segment, you're talking about, everybody's situation is different. Mm-hmm. If you're close to retirement or maybe you've got some transaction that's going on, selling a business or selling an investment property, whatever the case may be, where you may want to think through the variability of what that distribution schedule could potentially look like over the next 10 years.
Yeah, absolutely. So while you may be tied into having to take the required minimum distribution, that's generally pretty small in the whole scheme of things with the account. So you may want to consider taking a little bit out every year. If you're working now but retiring soon, you may want to take some out, more towards the end of your 10-year cycle when you're not working anymore.
Right.
There's a lot of different scenarios, or possibly skipping distributions for a year because you have another big, taxable expense going on.
Sure.
And so that's why it's so important to seek some financial advice if you're not sure if you need to take a distribution, number one, or to just kind of come up with a distribution schedule from, somebody who understands taxes and can help you with a situation like that.
Well, that's a great point. And I think in many cases, when we've worked with clients where, we literally sort of like created out like a spreadsheet of, okay,
right.
Year one, okay, this is what your anticipated income is going to be. This is what, other things that might be happening on your tax return are also going to look like. How much money should you take in that year? Because it really is important to sort of plot this out, because 10 years is not a long period of time.
It really isn't. And that's one of the things that is very unique with Nelson Financial Planning is not only do we give financial advice, but there's folks like myself and our CPA, Kristen Cayley, who also give tax advice.
Yeah.
And so we can help you on both sides of that spectrum.
Certainly that team approach that really integrates that really does add a lot of value beyond just kind of, my investments are X, Y, and Z. It's so important to be able to really understand the tax implications, because those tax implications, as we've seen just with this simple change on how inherited retirement accounts are treated, is pretty substantial. I certainly have referred to it on more than one occasion as perhaps the single biggest tax increase on your retirement accounts. And nobody really is kind of understanding that, because as those accounts pass, that's when the taxes are ultimately going to be due. That is for sure.
Right. And, coming up with this tax strategy means you may be paying 22% versus 32% if you do a little bit along the way. So it's a 10% tax difference. I mean, it there could be some big savings if you do a little bit of planning ahead of time.
That's exactly right. As is usually the case, that is for sure, but particularly with this. And then speaking of strategy and savings and thinking through that stuff, we talked earlier in the show about health savings accounts, medical IRAs, and those are not flex accounts. The balance carries forward, and I think that's the concept that a lot of people kind of miss on those.
Yeah, absolutely. Looking at it more from an investment perspective versus a medical perspective, if you can leave that money in there, it can grow until you're 65, and then you can use it for other things as well. So looking at, again, more as an investment account than extra money for your health benefits.
Yeah, and I think that's kind of the key concept. If you think about the value and what the health savings account brings to the table, it's triple tax deferred. The Roth is only double tax deferred, right? You don't get a tax deduction when you put money into the Roth, but you get a tax deduction when you put money into a health savings account. So the power of those to grow over time and compound really becomes another type of investment vehicle that you can use for your retirement.
Absolutely. The only caveat is you do have to have a high deductible medical insurance plan, which not necessarily everybody has.
That is very true. And it also is imperative that you look at the investment options inside a health savings account. Far too often what we see with these is that it's only money that's going into the default option, which is typically like a deposit account, so it's a cash type account. But they also have investment-oriented options as well. So if you really want to maximize it out and get the most amount of value out of that type of an account, really look at some of the investment options that are available. That is for sure. So, Christina, thanks for joining us on the program this week.
Well,
we
thank
really
you for having me.
appreciate
Yeah.
you joining us once again. And thank you to our listening audience for joining us as well. We appreciate their continued engagement. As always, if you have any questions or you'd like us to talk about a topic that you haven't heard us talk about in some time, just reach out to us, courtesy of our website at nelsonfinancialplanning.com. It's also there where you can schedule that absolutely free conversation and pick up your copy of our book, Next Gen Dollars and Cents, for free indeed. Remember, we don't charge for those conversations. We don't have account minimums. That means we are truly here to help you figure out your finances. With that, we'll get on out of here. This has been Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.